gold has this tendency to do nothing for a long time. If you were to look at it over a 50-year time horizon, yes, gold's a great inflation hedge, but it goes in these periods of times where it may be flat for a long time. A really great example of that is September of 2011, all the way to COVID, gold was flat over that time period. And that's because a lot of people expected a lot of inflation coming out of the great financial crisis that did not materialize. Because we spent a lot of that money that was printed during the great financial crisis just sat on the books of banks to keep them from going under, and it didn't actually find itself into the economy. And so we don't know what's going to happen in the next 10 years, but gold's up 26%. So it'll have these time periods where it's just up really strong, and then it'll do nothing for a long time. So it's not a very reliable inflation hedge. If you are going to make this your entire inflation protected portfolio, you want to build a more diversified base that may include other asset classes there. This data, when you actually look underneath the hood, it gives the Federal Reserve some really good reasons to cut interest rates. So from January to June of this year, the economy has added 782,000 jobs. Going back to the trend from 2015 to 2019 before COVID, from January to June, we were going anywhere from 1 million to 1.5 million jobs. So we're even below that. Now, as of right now, over half of the jobs are in the healthcare industry. And I think this has to do with just an aging population that we have. There's low birth rates. There's more people that are needed in healthcare. Maybe we have more chronic health issues in the country. But overall, the healthcare hiring could be a secular thing that would happen in either a good or a bad economy. And that's taking up over half of the jobs that have been added so far this year. Now, another sizable chunk of that is government jobs, is 17.6%. And those are mostly seasonal teachers and bus drivers that have been hired that are going to happen anyway. So when you strip out those two pieces, you can really see how weak some of the other hiring sectors are in the economy. And even though the unemployment rate hasn't picked up yet, we're not adding jobs in areas where you would if we were in a higher growth economy. And I think the Federal Reserve sees this underneath the hood, and I think this gives them a really good reason to cut, even though we're not seeing the 7-8% unemployment rate that you may see in a typical environment where the Fed would cut rates. Now, we've talked about the Fed, we talked about the economy. We get to talk about something that's very recent and new and exciting. It's the big, beautiful bill.
Signed into law on July 4th, 2025, really looks to expand a lot of the Tax Cut and Jobs Act provisions, but also add some new temporary provisions. So we'll get into a lot of those. This affects everybody, workers, families, seniors, businesses, and it's got, as I mentioned, some permanence to it, trying to really codify and make permanent the Tax Cut and Jobs Act provisions that were passed prior, as well as adding some temporary boosts and tax deductions to folks. Prior to this bill being passed, in the Tax Cut and Jobs Act, we had something called the state and local tax cap, which is the SALT cap, which said that folks that had more than $10,000 in property taxes or state income taxes or other kind of tangible taxes, they were capped at $10,000. And that really hurt a lot of our folks that have high state income taxes or have high property taxes because they weren't able to itemize those and get the full deduction for those. Well, the One Big Beautiful Bill comes in and says, hey, listen, we're going to raise this cap to $40,000 in 2025. We're going to increase that $40,000 cap each year by 1% through 2029. But take special note, this is a reversionary tax deduction. So it is going to revert back to the $10,000 in 2030, assuming nothing else happens. They've also included a phase out on this at $500,000 of modified adjusted gross income. So you can get less of this deduction if you're in those higher income, higher AGI areas. But they've mentioned that they want to keep the $10,000 as a floor. So you're still likely to be able to deduct at least your $10,000 if you are up in those high 500,000 plus modified adjusted gross income areas.
We're hitting the headlines early, so this next one's really interesting. It's the estate and gift tax exemption increase.
Yes, yes. So this was a big fear for folks who wanted to be able to gift or have their beneficiaries inherit property, and perhaps they were up above the estate tax exemption, which right now is 13.9 million per person. So there was a fear that when the Tax Cut and Jobs Act sunsets at the end of this year, that they would be stuck with their previous Tax Cut and Jobs Act exemption, which was 5 million adjusted for inflation. So call it 6.5, maybe $7 million per person. And so that is a big decrease. And so the one big beautiful bill comes in and says, nope, we're making this exemption permanent, and we're increasing it to $15 million per person, index for inflation in 2026. So a lot of folks who were perhaps worried about that generational wealth and whether they were going to be hit with those large 40% taxes on the passing of their estate to folks or to their beneficiaries if they were over those exemption amounts can rest a little easier now knowing that. But still, plenty of analysis needs to go into this in trying to figure out if you are going to be subject to these taxes.
Some people may be watching this going, well, I don't have 15 million. This doesn't apply to me. But if you have your investments, this is only indexed to inflation. If you look ahead 20, 25 years, you would think that maybe your portfolio might outperform inflation. So they may run into this in the future. So Franco, should they wait to do their estate planning, or should they meet with an advisor now and maybe start that process?
Yeah, you definitely don't want to wait to do your estate planning. So, if you've got $10 million today and you're not going to touch it for a long time and you're investing it and it's positive investment returns, you very well could have an exemption issue later on down the line. And so thinking about those things, talking to your advisor, no matter you have 10 million, 5 million, 100 million, you want to make sure that you speak to your folks and make sure that all your ducks are in a row so that your family doesn't have to deal with perhaps some estate tax or gift taxes down the line.
Yeah, I think the next few provisions here are some of the most interesting ones, and I think a lot of our clients are going to be really interested in this seniors deduction.
Yes, yes. So this one is really curious because right now it's being marketed a lot in the media as a deduction for folks who get Social Security income. And so I actually sat down with someone from CBS Miami and talked for a little while about this. This is much more of an age-based deduction than it is a Social Security-based deduction. So what it looks like is that taxpayers who are age 65 and older can get a $6,000 deduction. That's $6,000 per taxpayer age 65 and older, as long as you operate within these phase-out ranges. So if you're single filing, this begins to phase out at $75,000. And if you're married filing jointly, this begins to phase out at $150,000. So as I mentioned, it's intended to reduce or eliminate tax on Social Security, but as we know, there is a large band of time in which you can file for Social Security benefits. So take the example of somebody who is 62 and has decided to file early for Social Security. Well, they may be receiving Social Security benefits because they filed early, but they're not going to be eligible for this deduction because they're not age 65. So they're not getting the benefit of this. On the other end of the spectrum, there are folks who can push their Social Security filing date to age 70. Everybody can, and you get some increased benefit through your deferred retirement credits. And so what that would mean is that somebody who has decided to wait until age 70 but is age 65 is getting a deduction currently due to this, but they're not receiving Social Security. And so there are instances in which Social Security can be taken or cannot be taken, and this deduction still applies. So that's why I really like to label it more as an age-based deduction than anything else. Important to note that this is a temporary deduction as well, 2025 to 2028. This will sunset 2028.